and welcome to our last video lecture for Chapter 5. As we left off in the previous one, we were going to talk about recognition, measurement, and disclosure concepts. We were talking about the Statement of Financial Accounting concepts issued by FASB. So this is the recent development from FASB. So what we're going to actually do is define each of these concepts. So first and foremost, recognition. This is where you're admitting information into the financial statements. Recognition is highly scrutinized when it comes to revenue, and we will be talking about this in Chapter 5. And this particular Chapter 5 has been updated with the recent standards codifications that have been released by FASB. Measurement also is the process of where you're actually putting amounts into it, and we're going to talk about the different ways. It's usually historical cost, but there's other transactions that can take place in lower cost or market for inventory or fair value. And then lastly, we are going to discuss disclosure. No financial statement is complete unless it has their notes, which is full of the disclosures. So you have to include additional information in the accompanying notes to the financial statement. So a full set of financial statements, it includes the financial statements and it must include the notes. And remember, earlier in the chapter, we mentioned 4 different financial statements. So we have the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows. So that is our full set of financial statements, but it's not complete unless it has the notes. So the general recognition criteria, we have to define each element, measure it, and decide if it's relevant and reliable. So for revenue, it's basically when you're having assets or settlements of liabilities. So FASB just issued this auditing standards update, accounting standards update, which basically says that revenue is recognized when goods and services are transferred to customers. Again, they are transferred to customers. Revenue used to be recognized when earned. And now with ASU 2014-09, now they're saying goods or services, it's the transfer to the customer that allows for revenue recognition. And then we had, previously it was through the realization that you had the earnings process was barely complete and collectability. So now we are basically looking at revenue. Goods, we recognize revenue when goods or services are transferred to the customer. Expense, there's several approaches to expensing. Usually it has to be an exact cause and effect relationship. We associate the expenses with the revenues, known as the matching principle, and we will discuss that as well. And systematic and rational allocation, we do that through our depreciation. And the key is expenses have remained the same and they are still expensed when incurred. So revenue is now recognized when goods and services are transferred to the customer. Expenses continue to be recognized when incurred. So now we have a mixed attribute to measuring. And there are several ways in which we measure costs, right? We could do historical costs, which is you've adjusted it. That's usually through depreciation and amortization. Net realizable value, where you take cash and you convert it to what's expected to be collected during the ordinary course of business. Most notable through accounts receivable, where you have gross accounts receivable and you subtract the allowance for doubtful accounts to get your net realizable value. You have a current cost, which that would be what you need to incur to purchase the asset today. You may have a present value or you may have fair value. So these are all various measurement ways now. So historical cost, basically your original transaction value. So pretty much what you pay, you get. And same thing for liabilities. And then if you have a long-lived revenue-producing asset like production equipment or auto or buildings, then you can depreciate them. Remember, depreciation is for tangible assets and amortization is for intangible assets. Net realizable value is basically you're measuring the amount of cash that will be converted in the ordinary course of business. It gives us a better prediction of future cash flows. Future cash flows. So basically inventories, you might want to report them at the current replacement cost. So present value is our Statement of Financial Accounting Concepts 7. And basically that measures the future cash flows, but it's discounted at present value for the time value of money, and we will talk about time value of money in chapter 6. Fair value is also called current market value. That's in our Statement of Financial Accounting Concepts 5, and that is basically measured on the price that you'll receive when you either sell the asset or transfer the liability, and that's measured through various approaches like the market, income, or cost. Market is based on what the market will bear, the price that you can get in the normal capital market environment. Income, it basically estimates the future amounts, and then you have the net present value of that. And cost approach is pretty much what you're going to have to buy it for. Fair value, now it gives several companies an option to report their financial assets, which is usually investments at their fair value. So these investments, we will talk more about fair value in Accounting 305. But basically here you want to reduce the volatility of reporting earnings, and so now you can hedge, and the accounting standards allow that. And basically this is one of the main reasons that we can hope, this is one area that where US GAAP and IFRS kind of go together. Fair value is a common measurement standard with IFRS. So full disclosure, basically you have to include various pieces of information, not only on the face of the financials, but you need the disclosure notes. You might need supplemental schedules and table. Now, GAAP is evolving. We saw with the new standards on revenue recognition that basically say goods and services, the revenue is recognized when they are transferred to the customer. So now we're actually taking, GAAP is evolving from a revenue expense approach, which determines basically the amount and timing, and then an asset liability approach, which is based on the balance sheet date. So this is new and continuing to evolve, so this will continue to change. So now we have our conceptual frameworks and we are comparing them. So basically what IFRS does and what the US does and how they go about it. So these are just some standard differences. So this concludes our video lectures for chapter 1. Hopefully we've touched on several highlights, and this will help you complete your homework.